The easiest way to lose a fortune with ETFs is not to buy something obviously crazy. It is to take the wrong road while believing you are on the safe one. That is the danger. People hear ETF and relax too quickly. They hear diversification, low effort, broad exposure, steady compounding, and they assume the road is basically protected by the fund. Hold the fund. Let time do the work. Most of the time that instinct is directionally right. I have no quarrel with the idea that broad ownership, low friction, and patience beat emotional stock picking for most people. But what I do quarrel with is the fantasy that every ETF road leads to the same destination. It does not. Some roads charge you a hidden toll every mile. Some roads look like income roads and slowly drive you into a swamp. Some roads are chosen because a flashy billboard told you the next exit leads to easy wealth. And if you enter those roads early, the damage compounds so quietly that by the time you notice it, the lost money is not measured in annoyance. It is measured in years of your future. That is why I want to speak to you harshly. Because the ETF mistake that ruins people is not usually dramatic enough to scare them at the beginning. It looks reasonable. It sounds respectable. It often comes wrapped in the language of prudence. And that is exactly why it is so expensive. I have spent my life looking at capital allocation, and I can tell you something that most beginners never hear clearly enough. In investing, what kills you is not always the wrong destination. It is often the friction built into the route. You can head toward the right market and still arrive with less money than you should have. You can buy something diversified and still be quietly impoverished by hidden drag. You can collect cash distributions and still become poorer. You can read financial media every day and still be less informed than the quiet person who ignores the noise and looks directly at the instrument. That is why I call this a road problem. You think you are going somewhere safe. What matters is whether the road is draining you while you travel. The first wrong road is the toll road. This is the expense ratio trap, and it deserves much more fear than it gets because it is the cleanest form of legalized compounding theft in the ETF world. People treat the expense ratio as if it were a little decimal, a technical detail, something for spreadsheet people to fuss over. They are relaxed because it looks small. 1%, 0.5%, 40 basis points. It sounds harmless. Most financial pain begins that way, harmless at the start, permanent in the structure. An expense ratio is not a one-time fee. That is what people miss. It is not a ticket at the gate. It is a toll booth every single year, charged against the total value of what you own, not merely against the gains that make you feel rich. That means the toll scales as your capital scales. The better your money does, the more the toll collector smiles. That is a brilliant business model for the fund sponsor, not for you. Most ordinary investors do not think about that because the fee is subtracted quietly. Nobody sends you an invoice large enough to create emotional pain. No one forces you to sit down and write a check. The money is simply not there when it should have been. That makes the toll psychologically elegant. It hurts without sounding like harm. Now let us stop talking in adjectives and let arithmetic speak. Take $200,000, assume the underlying market returns 10% a year before fees. If the ETF charges 1%, your net return is around 9%. Leave that alone for 15 years and you end up around $730,000. Now take the same market, the same $200,000, the same patience, but use an ETF charging 0.05%. Now your net return is roughly 9.95%. Run the same 15 years and you end up around $835,000. That gap is more than $100,000. And where did the gap come from? Not from better timing, not from genius, not from superior risk taking. It came from refusing to drive for 15 years on a road with a predatory toll booth. Fay Felicite, Fay turn 49, file 0 Fay. That is the first lesson. The toll matters more than your emotions want to admit. People love dramatic mistakes because dramatic mistakes let them imagine themselves too smart to make them. The quiet mistake is harder because it flatters you while it drains you. A high-fee ETF can have a good chart. It can have brand recognition. It can have media attention. It can be attached to a sector you understand. It can even be attached to a market you wanted exposure to in the first place. That is why the toll road is so effective. It does not require you to act foolishly. It only requires you to act casually. Casual investors pay tolls for decades. Serious investors ask a harder question. If I can buy similar exposure with far less drag, why am I financing someone else's margin with my compounding? That question is not stingy. It is strategic. The crowd loves to say, do not sweat the small stuff. That is fine advice for coffee spills. It is idiotic advice for annual percentage drag applied across a compounding life. If your road tax is high enough, you are not sweating the small stuff. You are respecting geometry. This is why low-cost broad funds became such powerful tools for ordinary people. They did not make investing more exciting. They removed unnecessary friction, and removing friction is often the highest return move a normal person can make. Most people cannot outperform the market with brilliance. Many people can outperform their former selves simply by keeping more of what the market already offered them. That is what low fees really mean. Not magic retention. I want you to understand the moral insult hidden in high expense ratios, especially when attached to broad, generic exposures. If the fund is basically doing something that can be replicated cheaply, then paying a high fee is not sophistication. It is complacency wearing a tie. You are not getting elite treatment. You are funding a glossy wrapper around something you could have owned much more efficiently. That is why I become suspicious. Once I see expense ratios drifting above levels that can no longer be justified by real structure, you do not need a universal threshold for every category, because some niches genuinely cost more. But for broad core exposures, especially the kinds of ETFs many beginners start with, once the fee starts climbing meaningfully above rock bottom index territory, the burden of explanation flips. Now the fund should have to explain itself to you, not the other way around. The second wrong road is the yield road. This is where many investors who avoided the toll road still wreck themselves because they are not really chasing wealth. They are chasing the feeling of getting paid. And that feeling is strong. Do not underestimate it. A dividend distribution arriving in your account feels tangible. It feels adult. It feels like the portfolio is working for you. It feels like proof. Most people like proof much more than they like math. That is why yield is so seductive. It gives visible rewards early, and early visible rewards are where disciplined investing gets hijacked. I understand the attraction. Quarterly cash feels more real than abstract total return. It feels like progress you can touch. The problem is that many people start shopping for ETFs the way desperate men shop for shortcuts. They sort by yield, they get hypnotized by distribution rates, they see 6%, 7%, 10%, and their mind stops asking the adult questions. What owns this yield? What is happening to the asset itself? What happens to total return if the payout is high because the underlying structure is weak? That is where the road bends toward the swamp. Look at high-yield bond ETFs, and you see exactly how this trap works. A fund can advertise a 6.5% yield and still have a miserable lifetime chart. A $100,000 investor can collect cash for years and still be sitting on tens of thousands less in principal than where he began. The income did not rescue him. It simply softened the emotional pain while the asset base degraded. Another high-yield bond ETF can show something similar, juicy-looking cash flow on paper. But a long-term price path that tells a very different story. The investor thinks he is harvesting. In reality, he is partly liquidating his own future, while smiling at the quarterly deposit Fay file site Fay turn 49 file 0 Fay, that is the yield road. It looks productive. It can be stagnation with better marketing. The important idea here is simple and brutal. Yield on its own is not strength. Very often it is pressure speaking loudly. A high yield can mean the underlying assets are riskier, more indebted, more interest rate sensitive, more cyclical, more impaired, or simply less able to grow. In some cases, the yield is high because the price has fallen. That makes the percentage look generous while the asset underneath is already telling you it has a problem. People forget that yield is not a gift from heaven. It is a function. If the price falls and the payout has not yet adjusted, the yield can look better precisely because the road ahead got worse. That is why I say newer investors often chase the emotional residue of a cash payment rather than the economics of the total machine. They see the money landing in the account, and their brain says income. It does not ask whether the machine is decaying faster than the income justifies. The market punishes that kind of laziness over long periods. I want you to separate two things forever in your mind. Dividend behavior, asset growth. A good decision can involve both. A foolish decision usually ignores the second while fetishizing the first. You can get surprisingly far in investing by focusing primarily on asset growth and total return. You cannot make sound decisions by looking only at yield. That asymmetry tells you everything. One metric can survive without the other. The other becomes dangerous in isolation. This is why I have no patience for people who talk as if every distribution is a win. A distribution from a strong, growing asset can be wonderful. A distribution from a stagnant or deteriorating asset can be a sedative. It soothes you while the core value weakens in business life. That would be like celebrating a regular paycheck from a company that is quietly eating its own balance sheet. Adults should know the difference. The third wrong road is the billboard road. This is where the investor does not merely choose the wrong ETF. He chooses it for the worst possible reason. He saw a headline, a dramatic article, a story built for clicks, a must-own pitch, a famous name attached to a bold claim, or a promise that one neat ETF solved the exact fantasy he already wanted to believe. That is the billboard road. A loud sign at the edge of the highway telling you the next exit leads to easy riches. High income, explosive upside, or a once in a lifetime opportunity. The billboard is not built to get you home. It is built to make you turn. That is the incentive structure of a great deal of financial media. Not all of it. I am not childish. Some outlets inform honestly, some provide useful data, some reporters still respect nuance. But the business model of much financial content has nothing to do with your outcome. It has to do with your attention. And attention is bought most cheaply through urgency, drama, and emotional provocation. This ETF will triple. This income fund pays 10%. This famous investor is buying now. Do this before it is too late. These are not research prompts. They are roadside signs engineered to get a reaction before you start thinking. Fay file a site, Fay turn 49 file 0 Fay. That is why I tell people something very simple. Use media as input, never use it as instruction. The moment you confuse those two, you become prey. There is a reason the most reliable investing principles sound boring. Boring principles are hard to monetize with adrenaline, broad diversification, low fees, long horizons, total return awareness, simple categories, source verification, patience. Those ideas work. They just do not create enough emotional electricity for an attention economy that gets paid when you click in a heightened state. The billboard road thrives on that mismatch. It shows you excitement because excitement keeps the advertiser paid. It does not show you durability because durability is a terrible click-through strategy. This matters more than beginners realize because beginners often assume information is neutral. It is not. Information comes wrapped in incentives. The person showing it to you may be paid by advertising, distribution, sponsorship, asset gathering, audience growth, or plain old vanity. That does not automatically make the information false, but it does mean you must ask what the sign was built to do. Was it built to clarify, or was it built to trigger? Those are not the same function, Paul Samuelson once said. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take your money to Las Vegas. He was right because the most reliable road rarely feels cinematic. It feels dull enough that people with dopamine problems wander off looking for a billboard. The billboard offers intensity, the boring road offers arrival. I know which one I trust. Now let me put the three roads together because this is where the real damage occurs. A person sees a headline about a high-yield ETF. The billboard gets him to turn. The yield convinces him he is getting paid. The expense ratio quietly keeps collecting a toll while the asset itself underperforms. That is how losses get industrialized, not through one giant error. Through the cooperation of three smaller errors that each looked respectable on their own. That is why these ETF mistakes are so dangerous. They do not require recklessness. They require only a little vanity, a little impatience, and a little laziness around details. And details are where fortunes leak. The ordinary investor thinks his big decisions are asset class, timing, and whether he should buy or wait. Those decisions matter, of course, but there is another layer beneath them that changes outcomes more quietly and more permanently. How much friction am I accepting? What am I actually being paid for? Am I evaluating the instrument or reacting to the wrapper? Am I comparing like with like? Am I looking at total return or just the part of return that flatters me emotionally? Those are road questions, and road questions decide where compounding actually ends. Now, I want to say something that sounds obvious, but almost nobody behaves as if it is true. Go directly to the investment. Not the story about the investment, not the clip about the investment, not the influencer's feeling about the investment. The investment itself, open the fact sheet, read the expense ratio, read the holdings, read the methodology, read the long-term chart, read the dividend behavior, compare the fund with a cheaper equivalent, compare the total return, not merely the yield or the recent performance window. If you do that, a remarkable thing happens. The road becomes visible. A lot of flashy products stop looking mysterious and start looking overpriced. A lot of income products stop looking comforting and start looking constrained. A lot of media stories stop sounding insightful and start sounding like roadside entertainment for people unwilling to read the map. That is not cynicism. That is adulthood. Adults inspect the machine. Children inspect the packaging. The ETF wrapper is especially dangerous because it gives people false emotional cover. They think the presence of a fund automatically means the danger has been diversified away. Not true. A basket can still be weak. A fund can still be expensive. Diversification across poor assets or poor structures is not the same thing as strength. Diversification is not armor if the road itself is bad. This is why I prefer to think of ETFs the way I think of businesses, not as brands, as machines. What does this machine own? What does this machine charge me? What kind of behavior does this machine encourage? What kind of future does this machine likely produce if I leave it alone? That final question is the one most people avoid because it demands imagination beyond the current quarter. It forces you to picture not just next year as account value, but the shape of your wealth 15 years from now. The expense ratio matters there. The yield trap matters there. The media trap matters there. Early on, they can all look small enough to ignore. 15 years later, they are the difference between a clean compounding story and a long detour that stole 6 figures while you kept telling yourself you were invested responsibly. The market is full of people who lost money with respectable-looking decisions. That is why respectability is not my standard. Mechanics are my standard, and the mechanics here are simple. A high expense ratio taxes your compounding. A seductive yield can distract you from asset decay. A financial media headline can push you toward the exact product your emotions wanted before your brain looked under the hood. 3 roads, 3 mistakes, 1 destination. If you are careless, less wealth than patience should have produced. That is why I care so much about the beginning. Small errors made early are not small when attached to long duration. A beginner who builds on a bad road does not merely lose money. He loses years of correct compounding. That is harder to recover than people understand. Money can sometimes be earned back. Lost time rarely returns with the same generosity. If you are young, this should matter to you even more, not less. People in their 20s and 30s often dismiss fee drag and structure errors because their balances still look small. That is the exact stage when these mistakes are most destructive. A young investor does not yet have enough capital for the pain to feel large, but he has enough runway for the damage to become enormous. That is the cruel asymmetry of early investing. Small, invisible mistakes, huge later consequences. The mature response is not fear. It is filtration. Use a better filter before you buy any ETF. Ask 4 blunt questions. What is the cost? What does it own? What has the long-term total return actually been? Why do I want this fund in the first place? That 4th question is more revealing than most people expect. Many investors discover, if they are honest, that they want the fund because it promises a feeling income, excitement, simplicity, prestige, exposure to the thing everybody is talking about. The desire is emotional long before it is analytical. That does not make you stupid, it makes you human. But being human is expensive in markets unless you install better filters. This is why skepticism is a financial asset, not cynical paralysis, not refusing to invest. Healthy skepticism, the willingness to verify a claim, compare a fee, inspect a chart, read a methodology, and ask a second source whether the shiny road is actually taking you somewhere useful. I have lost count of how many bad investing choices would never happen if people forced themselves to perform that second source check. Follow a statistic back to its origin, follow the yield back to the price action, follow the article back to the incentives. Follow the great fund claim back to what you were actually paying for. The truth usually becomes much quieter and much more useful once you do. That is another lesson the billboard road does not want you to learn. The more direct the inspection, the less emotional the purchase becomes. And emotions are what sell bad ETF decisions. A high yield flatters, a high-flying sector fund excites. A familiar media brand reassures. A complex wrapper makes people feel sophisticated. The fact sheet usually strips all of that away and leaves only structure. I like structure. Structure tells the truth long before storytelling does. So here is the clean summary. The toll road steals from you through fees. The yield road distracts you with cash while total return rots. The billboard road hijacks your attention and hands your decision, making to incentives that are not aligned with your future. Avoid those 3 roads and ETF investing becomes much closer to what people naively hoped it was in the first place. Simple, durable, low. Friction. quiet, boring enough to work. That is the version of ETF investing I respect. Not the emotionally decorated version, the efficient one. If I had to tell a younger investor one thing, it would not be a ticker, it would be this. Do not mistake an ETF for a destination. It is only a road. And the road matters far more than people think. Some roads are built to carry you efficiently toward real compounding. Some roads are built to tax your impatience, flatter your emotions, and monetize your inattention. The markets will let you drive either one for years without forcing a confession. That is why you must force the confession yourself. Look at the toll, look at the exit, look at the billboard, then decide whether the road deserves your future. Most people will not do that. They will take the road that feels smooth today and expensive later. They will chase the yield that pays today and decays later. They will click the story that excites today and misleads later. That is their choice. Your choice should be better. Because the difference between a disciplined ETF investor and a careless one is not that one found a magical fund and the other did not. It is that one respected the road and the other trusted the sign. That difference can be worth well over $100,000, sometimes far more. And the compounding gap between those two people does not begin with brilliance. It begins with refusing to drive blind.